He's dead? Get out of there.
It's gonna be a huge loss.
It's okay.
It's not okay! I'm the guy who delivers!
Can't believe I'm saying this. We can't all be right all of the time. What's your level of certainty?
I am not uncertain.
Taylor knows I'm front-running their positions.
How can you find out what stocks smart money managers, hedge funds, and even Warren Buffett owns and make money from this? Well, we will discuss this and much more as we analyze Billions Season 4, Episode 3 based on my work experience at the top hedge funds in the world, my work experience starting a hedge fund, and my work experience at Goldman Sachs. Please like, comment, and subscribe, and stick around, because at the end of this video, we will grade the episode for Wall Street Realism with a buy, hold, or sell rating.
Mace Cap's positions and trading pattern.
Can we do anything with that?
We can do something with that. Buy up the price on names they want to increase their size and costing them upside and picking tiny little percentages off their profits. It'll be like the old water torture drip, drip.
So Axe Capital, through espionage, got access to the rival Taylor Mason's portfolio. And Taylor just launched the fund with $1 billion in assets to invest. Now, what stocks does Taylor own?
Take a look. Lock in all these positions, big gulp size.
Before I discuss Axe's strategy to hurt Taylor's portfolio and how can you make money by knowing what smart money accounts own, let's quickly discuss Taylor's portfolio and how hedge fund portfolio management actually works. Now, here we have Taylor Mason's portfolio, and this is a screenshot from Bloomberg that Axe Capital got illegally. And let's just assume that this right here in the green box is Taylor's entire portfolio. Now, most of these tickers are pretend tickers. We see 8 longs and 7 shorts for a total of 15 positions. And a lot of hedge funds have a minimum of 20 positions, and many try not to have more than 5% of assets under management in any one position. That's just good risk management. And here we see Taylor has a few 10% positions. Now, of the $1 billion in assets under management, we see here that Taylor only has $448 million deployed as the fund recently launched. And this means that about 56% of the assets are not deployed yet. Now, in terms of net exposure, meaning longs minus shorts, we see that Taylor is 48% long, which is calculated as longs minus shorts divided by capital invested. And most hedge funds run net long. Now, a fund like Taylor's might use up to 50% leverage, meaning Taylor might invest up to $1.5 billion. Now, many large funds use leverage of 4 to 6 times if their net exposure is between 0 and 10%, meaning they more or less run market neutral. Now, in the fall of 2008, many funds used 10x leverage, and many of them actually went bankrupt. Now, how is Axe going to hurt Taylor's portfolio?
Lock in all these positions, big gulp size.
Excuse me, Axe. There are other plays that would yield more upside.
Yeah, we're limiting the upside for someone else.
So here is what Axe is getting portfolio manager Ben Kim to do. He's getting Ben to drive up the prices of these 5 smaller long positions before Taylor makes them full positions of each at least 5% of capital. And this will destroy Taylor's ability to make money in the near term on these ideas and hence hurt Taylor's alpha, meaning how much Taylor outperforms the market by. And Taylor's trader Maffei realizes what's going on here.
Explain the discrepancy between realized gains and expectations, and don't you dare blame latency.
Okay. Transaction costs were a little higher than we modeled. There seems to be more adverse selection than we anticipated.
Can we just say it? We're getting front run somehow.
Obviously.
So front running is trading ahead of a customer order using knowledge of that order. Now, if you notice that Warren Buffett's portfolio just started a position in Google, and you think they will buy a lot more, then you can buy more, and this trade has worked really, really well. Now, here is how you can find out what funds like Buffett owns. So by law, if you manage more than $100 million in a hedge fund or a mutual fund, you have to disclose this every 3 months on SEC.gov in what is called a 13F filing. And people make a lot of money off of what I'm about to show you. So let's see what Warren Buffett owns as of the last filing. So here's how we do it. Step 1. Let's go together to SEC.gov and let's type in the name of Berkshire's fund, which is Berkshire Hathaway. Step 2, we select View Filings. Now, step 3, we search for the most recent 13F, which is Buffett's holdings as of the quarter ended March 31st, 2026. And let's click this filings rectangle right here. Now let's click the information table. And here we see what stocks Buffett owns, including Alphabet, which is Google. Now, what you can do is you can see if he added any new stocks or sold shares in stocks in the March quarter. Why would you want to do that? Because a massive firm like Buffett can move stocks if the firm starts building a new position, and many people copy his trades. And Berkshire manages more than $250 billion in stocks. I know that Warren Buffett sort of retired. Now, we see here that he currently owns about 58 million shares of Google, meaning about $20 billion, which is relatively small size compared to his roughly $70 billion current position in Apple, and his Apple position was once much bigger than this as well. Now, if we look at the November 14th, 2025 filing, we see that Berkshire only owned 18 million shares of Google. And per the data and the chart you see right here, as of the recording of this video, since the filing hit sec.gov on November 14th, Google has massively outperformed its peers, although to be fair, some of the peers listed here are not perfect comps, and some have their own capex and other related issues. Now, always do your own research, but following the smart money can be helpful. And when you do investment research, of course, per my stock research report generator here that I give to my clients, you have to do a ton of your own due diligence and don't just rely on what others do. And if you want access to this as a client of mine, please see the link in the description or set up a meeting at this link here. Now, it can take a long time for large funds to put on new positions or sell shares. And when I worked in the hedge fund industry, I saw that mutual fund giant Fidelity was buying shares in software company Novell when it was a public company. And I made a lot of money humbly, buying partially because of this, as it takes large funds like Fidelity quite a while to put on core positions. And you can also make money by shorting stocks if a hedge fund is selling shares, if they get redemptions, or if they're going under, or if they are selling a massive position, which takes a while. Now, let's revisit this clip from season 2, episode 12.
If we needed to liquidate all our positions quickly in order to get into cash to offer redemptions without taking losses, how would we do it?
Now, since you understand the 13F concept, this will now make a lot more sense to you.
What you were asking about was how to protect the portfolio in the worst case scenario before word leaks on the street.
When that happens, everyone will look at our most recent 13F and start shooting against our liquid names.
And the only way to beat him to it is to have sold first.
Now, the risk with Axe Capital in that episode is that he wants to liquidate his fund quickly before the market finds out what he's doing. So this can be really hard to do if he owns shares in stocks that don't trade that much, meaning illiquid stocks. So what should Axe do?
And I'll use 6 different brokers with 6 different baskets, $1 billion each. Currency, tech, big pharma, etc.
Now, one of the strategies Axe uses is to sell using 6 different brokers, which is smart. So it's less likely that the street knows that they're liquidating their portfolio. Now, what other ideas does Taylor have?
So, what do you have for me?
I take over the program trading desk and export our holdings. I load up the whole program and then import them into the trading system. I'll create a phantom algo for our biggest illiquid names to protect against the high-frequency guys.
Program trading is when a computer buys or sells shares using predefined parameters. For example, selling shares at certain limit prices at certain times and through different brokers. And program trading is often used so that we don't sell all of our shares at the same time, which can push down the price of stocks, of course. So programs will sell a smaller amount at different time intervals. And some people estimate that 80% of all trades are now done using program trading, up from about 50% last decade. And this makes sense partially because more investors are transacting in ETFs like the VU, which mirrors stocks in the S&P 500. Now, if an ETF gets inflows or outflows of capital, it's easier for them to use program trading to buy or sell stocks in the S&P 500, for example. And part of program trading is trading algorithms. And more investors are using artificial intelligence, of course, to transact in stocks. And the best example of this is Renaissance Technologies, an amazing fund founded by the brilliant late mathematician Jim Simmons. Now, Simmons founded Renaissance in the 1980s after he left the NSA. And Renaissance's returns have been well over 50% on average annually since the 1980s. And nobody knows exactly how Renaissance does this, but they only hire mathematicians, and their AI algorithms might include the following simplistic example. This is really simple. But if it rains a lot, then short restaurant stocks because people don't go out to restaurants as often when it rains. And by using program trading, we can reduce human fat finger errors, which means somebody accidentally adding too many zeros when buying or selling shares, which has bankrupted many companies or resulted in employees being promoted to managing director. Now, another type of algorithmic trade is high-frequency trading, which means rapid buying and selling of shares. And an example of this might be with SAP, which is listed on the United States and German markets as well. And if SAP listed in the US is priced too high compared to SAP in the German market, then high-frequency trading might go long the German SAP share and go short the American ADR SAP shares. And high-frequency traders don't often own stocks when the market is closed. And HFT, or high-frequency trading, is controversial because it often leads to increased volatility in stocks. I'll give you a great example. On May 6th of 2010, I remember this well, this basically led to what is called the flash crash, where the markets temporarily fell close to 10%. I remember I was running back to my office that day. And this was partially caused by one trader who got into trouble for creating a spoofing algorithm. And Taylor told Axe that they will create a phantom algorithm to protect against the high-frequency guys. And we don't know exactly what this means, but it could imply using an algorithm to make it look like Axe Capital is not selling many shares in specific stocks. Now, Axe could also use options if he can find liquidity in the options market to protect himself. Now, let's get back to the current episode. As you can see here, Axe Capital put up a camera outside of Taylor Mason Capital's office, and they're taking pictures of this whiteboard here, which is a complex set of formulas for trading. Now, what is Axe going to do with this?
Got something for you?
This is the can opener in the fallout shelter. Nicely done.
So Taylor's whiteboard is actually filled with real quantitative finance. I'm a finance and math geek. I did work on this. And it's basically advanced math used to figure out what options and other complex investments should be worth while accounting for the fact that markets and volatility are constantly changing. Now, in simple terms, so I can understand it, it's the kind of math that helps quantitative hedge funds find tiny pricing mistakes and make trading decisions using algorithms instead of gut instinct. Now, what does Axe make of all of this?
Wiki me up to speed.
Taylor knows I'm front running their positions. They've figured it out. This is their solution to that. How they're gonna spin it to pick up the basis points that we were stealing.
So maybe all that math on the board is to make a few more basis points, but this seems really silly to me. I mean, a few basis points means about 0.02 to 0.04% of performance. So what's really going on here?
Me. There's a mistake.
That's good, right? Let them run with it, blow themselves up. Only Taylor doesn't make math mistakes.
No. They knew they were being watched.
So Taylor is using game theory to mess with Axe's head, and nobody wins in this war. Now, right here, Axe and Taylor meet.
I don't want to be at war with you.
Yeah. I got that you were proposing armistice the second I looked at the algorithm.
It's a distraction, to me and to you. It prevents us both from operating at our full potential.
So well written. And this is accurate. Money managers can't beat the market if they're distracted. Kind of like how you don't invest in a company if the founder is distracted. Like when Elon Musk was distracted when he bought Twitter, or when Elon Musk was distracted when he worked for Doge for a while there. In fact, some hedge funds short companies when the founder running the company gets distracted, like when they buy a sports team. A jack of all trades is a master of none. Now, what does Taylor propose here?
Let's stop, not waste ourselves on each other. I'll offer you attractive terms to invest in my firm. The street will know that I am blessed by you, but also that I am giving you a look. In reality, I won't be giving you that look, but the story will be enough for it to appear that you are in the dominant position.
Okay.
So, smart move by Taylor, appealing to Axe's giant ego. Now, separately, in this episode, Axe's corrupt portfolio manager, Dollar Bill, is trying to make a killing by buying the Arkansas Chicken Index. because of this.
Latest numbers land today. We need to be long.
Because there won't be any chickens?
It's better than that. There's plenty of chickens, and the early chicken action is counting on that. But Chicken Man will say that there's very few chickens, and the price will skyrocket.
So if the supply of chickens goes down, then the price will go up. Now, the reality is there is no Arkansas chicken index, and hedge funds would likely transact instead in companies exposed to poultry like publicly listed Tyson Foods or Pilgrim's Pride. Now, how confident is Dollar Bill about this trade?
What's your level of certainty?
I am not uncertain.
Size up the position. Could mean a $300 million win.
So that level of certainty means Dollar Bill used insider information to get his edge. And if the information is not available to all investors at the same time, then this is against the law, of course. Now, the other problem with this trade is that the chicken man Dollar Bill is relying on died. So the catalyst of Chicken Man saying the supply of chickens is low in order to drive up the price of chickens is gone. So what does Dollar Bill try to do next to reduce chicken supply?
What's in the bag, Bill? What's in the bag?
A capon with a case of H5N1B. Just enough to freeze transport on a few 100,000 infected birds. Prices will skyrocket.
So will Axe let him do this, though? I mean, is Axe more ethical than Dollar Bill?
They're getting killed anyway. This just accelerates the process. That's all.
That's a good point.
Right.
But there is a cost-benefit analysis to take into consideration here. That of poisoning the food supply. One I am familiar with, as you know.
So recall that in season 2, episode 11, Axe got caught adding poison to ice juice and shorted the ice juice IPO and made a killing on it. Now, please see the link in the description for my reaction video on this episode where I explain how an IPO works.
If I don't do this, it's going to be a huge loss.
It's okay.
It's not okay! I'm the guy who delivers!
But, and I can't believe I'm saying this, sometimes you just gotta take a loss.
So Axe is right. Aside from the legal issues, sometimes you got to take a loss on trades so Axe can live to trade another day. And the best investors are highly unemotional and they adhere to stop losses. Let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did a superb job of showing how commodities-based supply changes can lead to price hikes. However, the episode was unrealistic in that there is no way a hedge fund would spy on another hedge fund with the intent of trying to drive up their longs. The data could easily be analyzed by the SEC. What was also unrealistic is that a hedge fund would poison the food supply in order to make money. As a result, as much as I love this episode, I'm going to give it a sell rating. Please like, comment, and subscribe, and I will see you in my next reaction video, which is Billions Season 4, Episode 4, which will be my 40th review of a Billions episode. Please see the link in the description to access all of these reviews and my reviews on many finance movies, including The Big Short, Wall Street, Margin Call, and many others, and thank you.